But let's take the conversation forward. What's the market construct looking like, not just for us, but various asset classes in the world as well? Laurence Balanco, technical analyst at CLSA, on the show with us. Laurence, hi, good morning. Good to have you on the show. I guess first thing that everyone is talking about is where is the dollar headed? What are the charts looking like? Does it seem like that's going to be the top trade for even 2025?
Well, I think it's the biggest risk for emerging markets for the rest of 2025. December, we did see a breakout of the trading range that you had between 2022 and 2024. And that was a range that the dollar index traded between 100 and 106, 107 was the top of the range. And ultimately, that suggests an upside target of 114. Now, if we look at the shorter term profiles, running into the inauguration, we did have some exhaustion signals from our DMARC indicators, but also if you look at our momentum indicators, we had some slowing upside momentum. So some kind of mean reversion trade and retest of the breakout area is what we're seeing currently unfolding. And there's likely to be a little bit more of that trade to go back towards the 106 area. But as long as the dollar index stays above 106, that breakout that you had in December still gives you the potential to trade up to 114, and that'll keep the pressure on emerging markets with that kind of price action.
Laurence, so on a scale of 1 to 10, what are the chances that the dollar first will make a new high? I'm talking about the dollar index, which is at 114 or 15. Then it peaks out. I mean, do you think in this ferocious dollar uptrend, we must remind our viewers that before we think of even talking dollar has hit a peak, dollar is nowhere close to its previous high?
Yeah, look, so basically from current levels, it's 5% away from the highs that you made in September 2022. But if you look at a longer term chart, obviously the major peak was back in the 80s for that dollar index. The way that we'd look at it, as far as the lows going back to 2008, this is the longest uptrend that you've had in the dollar index, going back to the 70s when the dollar was taken off the gold standard. So as far as duration of a move, you're still in that uptrending phase, and it's the longest uptrending phase that we've had. Now, to answer your question, a move back to 115, 114, can that be part of a much more significant peak in the dollar? Yes, that is likely the case. And, out of 10, to give you a number, I'd put it around 8 out of 10 that's retesting and making a double top in 2025 is a highly high probability scenario from a price pattern perspective that you get a major double top at that 114, 115 area.
If the dollar, and I'm just going to come up with one more follow-up question on dollar. If the dollar stays where it is, which is closer to 100, 110, do you see a further rout in emerging market currencies, including the rupee?
Yeah, look, I think if dollar stabilizes around this 109, 110 area, emerging markets can actually start to make some gains and grind higher. So, it is, if you look at yields as well as the dollar move, it's always about the delta or the rate of change. And a grinding move higher in the dollar index, I think most equity markets can overcome that kind of action. But if you get at the accelerated moves, both on yields as well as a dollar, that's a real headwind for emerging markets. So having some stability, even if it is above the upper boundary of that trading range that I've highlighted, I think emerging markets can make some headway with the dollar still holding around 109, 110.
Laurence, wanted to understand, since there is that strong correlation in the dollar strength and, what it would mean for emerging market flows. What do you see on the charts for the Nifty? Because we've already cracked a good 11% from the 52-week peaks. Where next now?
Yeah, so unfortunately, we still remain in this sort of corrective pattern, having broken below the 200-day with the price action at the end of December and the start of January. So there has been the most meaningful technical damage done to the Nifty since the 2022 price action. So, I think like the dollar index is due this sort of pull back to 106 in the near term, we can see a rebound rally back towards the 24,000 to 24,500 area on the Nifty. But this is still likely to be part of a consolidation and corrective pattern that still has some work to be done. So yeah, if we're talking about very short-term price action, I think the Nifty can rebound towards the 24,000, 24,500 area. But if we're looking at it to the end of this quarter and the start of the second quarter, we're likely to still be in a choppy corrective period for the market.
So, Laurence, in this fall, or rather in this corrective phase, sectorally, what are the trends that you're picking up? What would underperform? And let me start off with the private banking names, you know, your HDFC, Kotak, ICICI Bank, you know, the larger ones like an SBI and what have you. Without getting into individual names, as a trend, what do you foresee for the Nifty Bank? Because it's really been, you know, unable to be in that sort of knight in shining armor for the market, if you will.
Yeah, sure. I mean, so let's just take a step back and look at Nifty banks itself. Relative to the Nifty, you know, you've had a period of 18 months of underperformance. As we ended last year, the fourth quarter, we actually started to see banks come back to the fore and give you some relative outperformance. And that was really driven by the recovery in private banks over the PSU banks. So if you look at private banks versus PSU, you had or seen a derating of private banks versus the PSU banks from the COVID lows into 2024. But as we ended 2024, private banks had actually broken out versus PSU banks. And interestingly, over the past week, yes, private banks have given back a bit, but relative to PSUs, they've broken the downtrend from the 2020 high. So I think on a longer term basis, private banks are starting to re-rate versus PSU banks, which have outperformed for the past 4 years. So I think that trend still has further upside despite this week's underperformance from the private bank side. And then versus the broader market, you know, we have been underperforming on the bank side. But ultimately, I think once we're through this corrective phase, I would look for private banks to be one of the key drivers to the upside. And it's starting to show up relative to the PSU banks first. So yes, in absolute terms, we've got a lot of volatility. But that relative price action, I think, is quite telling for a longer-term view within the banking space.
Laurence, the other, conjecture in the market has been what the Trump presidency could really mean for IT services. Now, we've seen that over the last 3 years, most of these stocks have given you only a flat return. Yes, in sporadic moves, few of them did give you good returns in the last 6 months or so. But the future seems a little bit hazy because the earnings have been quite a mixed bag. What is it that you foresee for the Nifty IT?
Well, interestingly, with the correction that you've seen, you know, from December through the start of this year, your typical defensive sectors in IT and your dollar earners, IT, pharmaceutical, and even the FMCG space gave you relative outperformance in December through to January. IT itself, the index is pretty much in a trading range that you've seen since the highs that you made late third quarter. And that's what gave you the relative outperformance. And I think, too, the information that you're getting from the results is it is more selective. So Tata Consulting is probably the more constructive of the large cap IT names, but it is a trading range and it's holding up better in that trading range. So we're not seeing any absolute breakouts within the IT space. And you're only getting relative outperformance because the broader sector is managing to hold that range.
If the market were to decline further, which you believe that we are in, further downturn on the charts, is there any buy signal that you're getting? And if we were to fall to those 22,000 odd levels on the Nifty, what do you think is going to recover from there the fastest?
Well, again, I'm really sort of focused on that longer term setup on the private banks as a key space that I'd look at buying or trying to get set up in the volatility and the corrective phase that we've seen currently. And then on the negative side, where I still think there's further downside is coming from the broader PSU, not just the PSU banks, but if you look at the BSE PSU index, that's been in a downtrend basically since September last year, having broken below the 200-day. We keep on getting rebound rallies and it's capped by the 200-day now. So a clear change in behavior in the PSU side, as well as autos being under pressure. So that's what I think gets the market closer to the 22,000 area. What I'd focus in on buying closer to that area is looking at the private banks for leadership coming from them post this corrective phase.
This is Shrishti also joining in. Laurence, the last time we connected with you, you did highlight some of the sectors like autos, consumer goods, and even real estate wasn't looking that great to you. And you also felt that the correction could stretch for a little longer period. Given the correction, Laurence, any other sectors that that may not look that good to you at this point in time and maybe can join the party given the bearish signals?
Well, like I say, to me, from that previous update, real estate still acts poorly, and you've seen the weak price action over the past week with the continuation of the sell-off. But the new sector, or just to reiterate, the broader PSU weakness and underperformance that you've seen from that broader space, not just the PSU banks that have bounced in the short term. So, I think investors have to look at this price action on a very short-term time horizon, that we do get a rebound rally, but then on a 3 to 5 months basis is that there's likely to be further weakness, and that would be the next buying opportunity closer towards that 22,000 area. So yes, there's a difference between that sort of tactical setup and where we think there's a better longer-term entry point into the market. So remember, our longer-term upside target for Nifty still sits at that 37,500. So we are just trying to find better entry points in this volatility.
Laurence, let's look at a very crude definition, which is that which markets are still in a bull market and where you think they still have a long shelf life. Which market do you think are nearing the end of the bull market, and which market do you think have slipped into the bear market? You can cut across markets, you can cut across any region.
I think if you look at the on a macro side, the bear market in bonds is still very much in place, and seeing yields continue to press to the upside, particularly in the developed market world. That's where the pressure point is on the macro side. Let's deal with China, because I think our technical outlook is that we're in the cyclical consolidation pattern similar to what Japan went through post its 89 to 92 decline. So we think there's a lot of tactical trading opportunities. So we don't think there's new lows to be had in that market. But as far as persistent gains to the upside, we're likely to cap there. So I think of that more as a trading range setup. And then if we look at Japan, we still got a longer term upside target for Nikkei 46,500. And maybe more recently, breakouts that we've seen in Europe, having done nothing through 2024, you've had this trading range, you've broken out of that, and that's been led by the European banks. So that's to give you sort of some flavor, across the board from the shorter term side and even on the macro side, where we see that bond market bear setup, particularly for developed market bonds.
What is the high yardstick number for the 10-year? Technically, do you think it can go above 5? Can it go beyond 6? What is that level for the 10-year, US 10-year?
So basically 5 to 5.25% is the next target level that we're looking at. So the most recent high that we made around 4.75, momentum did confirm that, and the next level above that is 5% to 5.25%. I don't have a measured move up to 6%. There is a resistance area at 6%, and some technicians have sort of focused on that. But from the setup that I'm focused on, looking more at the 5 to 5.25% area.
And what's the Nifty target at the lower end of the band, Laurence, that you foresee if we were to continue in the corrective phase after the short-term rebound that you just spoke about?
So 21,700. So that basically puts you at the bottom end of the trading range that you had prior to the India elections that we had last year. So around that 21,700.
Great to have you on the show. Thank you so much for your time today.
Thank you.
Thanks.
If you like this video, then like, share and subscribe to ET Now.